And today's insight from Team Innovate is from our mortgage advisor, Madeleine Newmann-Curry. Madeleine, over to you.
Thanks, Keith. So, hi everyone. Hopefully, you all know who I am and what I do by this point. But if you don't, I'm a mortgage and protection advisor who is absolutely not passionate about mortgages at all, as I said earlier. So, why am I in this business, you might ask? So, I am passionate about helping people buying a home, whether it's your first home, second home, an additional property, you name it. It's a huge financial decision and it's not one to be made lightly. So not only are finances involved, but so are emotions. And it's a journey, right? So I help people on their journey, making maybe one of the biggest and most important decisions that they'll have made in their life so far, especially for first-time buyers. So as mortgage products are incredibly boring and I'm just not that passionate about them, I'm not going to talk to you today about what a mortgage is, what the current market's saying, rate predictions, none of that. What I thought I'd talk about is a couple of case studies. Of course, being within GDPR limits, that's a hot topic in mortgages. But I just want to give you an idea of who I can help and what I can help with, and maybe what I say might resonate with you, or I might spring to mind when you're speaking with friends or a colleague or a family member. So case study number one, we've got a solo applicant, they're a first-time buyer, they've got a 10% deposit, and affordability is not quite meeting what they need to purchase the property. So this is actually something I've seen all too often, especially this year, affordability not quite hitting the mark due to high interest rates and average income multiples. And by income multiple, what I mean is the level of mortgage lending that you can acquire is based on a number of factors, your income being one of them. So the majority of lenders fall around the 4.5 times your income, and that's the potential loan amount you can have. So for example, if you earn £40,000 a year, multiply this by 4.5 or 4.5, that's your mortgage amount. It's absolutely not that simple. I wish it was. My job would be so much easier, but it's also not accurate. But that's kind of what the lending amounts are based around. And it gives a really crude idea, I suppose, of what you could potentially borrow. And for a lot of my first-time buyers, it's just not enough. But there is a higher income multiple shaped light at the end of the tunnel, if you will, specifically for first-time buyers. So not one, but two lenders are now offering higher income multiples, so up to 6 times your income for joint applicants earning £50,000 a year, or for solo applicants earning £30,000 or more. And the reason I've mentioned those salary points is because there is a fair amount of criteria around these products. So it is absolutely imperative that you speak to a mortgage advisor, because that's what we do. That's our expertise. Only 2 lenders out of the whole market can offer this. So if you don't know who they are, you might be screwed. So for this client specifically, I placed them with one of these lenders and they received a mortgage loan of almost £40,000 higher than what other high street banks were offering. So it's a huge, huge amount. And she's now very happy in her new home. But just on affordability, I don't want to forget the non-first-time buyers. So there are several lenders who offer higher loan amounts for those. For example, if they've got an inflated level of income, so if you're a solo buyer with 75k or more earning in a year, you might be able to borrow more. For anyone working with the NHS, now this isn't limited to doctors and nurses, it's also for all NHS staff like receptionists, admins, cleaners. If you are employed by the NHS, you could be liable for, well, you could be applicable for a higher lending amount. As well, certain professions also benefit from this. So we're talking vets, architects, accountants, firefighters in some instances, all can benefit from high income multiples, but only with certain lenders. And I could probably count on 1 or maybe 2 hands the lenders that offer this. So again, speak with the broker, very important. So that's affordability for that case study. My next case study, we're going down the colourful credit history route, which is what I kind of specialise in. So this was a joint application. We've got a 20% gifted deposit from a parent. Only one of the applicants is employed and they are still within their probation period, only having returned to work after a little bit of a break. The applicants receive multiple benefits, and these benefits are required for affordability purposes. So some lenders can accept all benefits, others can accept some over others. They may accept only a percentage of the benefits. The benefits have to be received for a certain amount of time. Again, criteria is a little bit of a minefield on benefits. Speak with your broker. Also, in this case study, we had missed mortgage payments from the past and 6 registered defaults. So this is where a creditor closes your account because you've missed so many payments in a row. It's usually 6 payments, and then a default was registered against you, which in the eyes of a lender isn't too favourable. So this case wasn't easy at all to place by any stretch, but I can confirm that the couple are very happy in their new home. And with this one, I had to use a specialist lender who have slightly higher rates than your average high street. So we're talking between 1% and 2%, but it was totally necessary for this couple because their main priority at that time was to buy a property and build a home for their blended family. So another successful but tricky case. And then following this colourful credit history trend, my third case study for you, this was an interesting one. So it was another couple. They were relocating around 3 hours from where they currently live. They have a high debt to income ratio. And by that, I mean, they have a lot of credit cards and mail order cards, all with quite a high balance, unpaid, compared to what they were bringing in terms of income. They also had multiple credit blips, including defaults, CCJs, and a debt management plan. All of the above, again, not seen too favorably by lenders, but absolutely placeable. So I get a lot of clients that say, oh, I've got, a really colourful credit history. I'm never going to get a mortgage. Not the case. Let me see your report. Let's see what we can do. No problem. Also, with this case study, they had a 10% deposit. So, on the lower end of the deposit scale. So a couple of points on this one. The relocation can absolutely be an issue, especially if you don't have work lined up in the new area or your job isn't transferable or remote. So the commute, if still applicable, it has to be sustainable and it has to make sense to the lender. If you're commuting 3 hours one way, 3 hours the other way, realistically, is that going to be sustainable over the long term? No. So yeah, not having a job lined up in an area that you're moving to is a big no-no. Luckily, this couple both had totally remote jobs, so it wasn't an issue. The next point I just want to flag is the debt to income ratio. This has a massive impact, especially on how much you can borrow. So that essentially, the more debt you have, the lower the loan amount available. It's kind of as simple as that. So I always say, if you can, pay as much debt off as possible. But equally, it is still possible to get a mortgage with credit card debt, mail order debt, financing items. It's still possible. It just lowers the amount. And if you're scraping the barrel, it's not going to be clever to have too much debt. And then also the credit blips, we'll call them. So what's showing on a credit report can really influence the deposit amount required. With this one, they had 10%. So, kind of low, but luckily all of their credit blips were 3 years or more old. They've been registered 3 years prior to the application, which met lender criteria. So there is currently only one specialist lender on the market who can accept multiple default CCJs with a deposit below 10%. So a minimum of a 5% deposit, just one lender. And I think that's quite innovative of the lender because, we're dealing with people who've not been able to keep up with their finances in the past. Yet this lender's saying, hey, look, you've made amends. We trust you. You can put down a 5% deposit. We're happy. But just the one lender. There used to be 2, but the other one keeps pulling their product, bring it back, pulling it, blah, blah, blah. And then in terms of a 10% deposit, which it's not a bad deposit, but with adverse, you like to see a little bit more. There are around 3 or 4 lenders that can accept this, but there is so much criteria around this, especially with adverse accounts. So they're looking at things like when were the defaults registered, for example, how much they were for, what they were for. Some lenders can accept defaults or CCJs under £500. Others can't. If it's a communications or telecoms default, they can potentially ignore it. So there's so much criteria. So anyone with adverse credit, definitely download your report and get it checked before you do anything else would be my advice. So with this case study, again, another very happy couple. They're in their new home and they're so happy. They actually sent me a gift and wrote me a wonderful review. So to conclude, I can help a number of clients, whether it's a straightforward remortgage, applying for further funds. However, I really enjoy helping first-time buyers and anyone with a colourful credit history. And it's probably because I love a challenge and I really don't give up easily, even when I probably should. And it's just the feeling of being so happy for someone I probably have never met face to face, just knowing that I've made an impact and they're actually in a home that they've worked so hard for. It just takes away all the stresses that the job brings, and that's what I define my success on, helping people get to where they need to be in their journey in life. So that's me, and thank you very much for listening.